All right, so where's the stock market going to be in 2019, and what are going to be some of the drivers? I'm going to start early with just GDP over the course of the first quarter, second quarter, third quarter, and fourth quarter. Historically, GDP's averaged between I don't know, about 1.7 to about 2% for the first quarter. And sometimes it's significantly lower. The first quarter tends to be the weakest quarter out of the four quarters, with the second quarter typically being the best, and the third quarter typically being the second best quarter. However, next year, due to deceleration in the broader economy, due to some of the headwinds like tariffs, the possibility that the Fed may actually hike one additional time, and also just some of the geopolitical risk that are going to be rising in 2019, as well as just some of the things going on in Congress. So if you want to look at what the market is going to price in, and whether the market's cheap or whether it's expensive, I think you have to start with the core of where GDP is going to be for those first quarter, second quarter, third quarter, and fourth quarter, and then where do you think it's going to be for the full year? So you can look at a lot of the data coming out from the Federal Reserve. You can look at the survey of professional forecasters, and you can look at a few other survey data points. Right now, they're sort of in the camp that we're going to be as low as possibly 2% to as high as possibly 2.7%. So that's a significant drop-off from where we were at the end of this year, in the sense that we did close in on about 2.9 to 3.1% growth, depending on how the fourth quarter numbers this year are going to be calculated. And we won't know that data until close to the end of the first quarter in 2019. So what I think for the first quarter of 2019, my base case scenario right now is that we see 1%. Possibly 1.05% for growth in the first quarter. I think the second quarter we're probably going to see about 2.8% growth, and that's going to be the strongest quarter out of the four quarters. I also think that we'll see 2.35% growth for the third quarter in GDP, in real GDP. All these are real GDP. And I think for the fourth quarter, we'll see 2.05% growth. So in total, I'm looking at growth for the next year that's going to be above trend. When I say it's going to be above trend, what I mean is that trend is between 1.7% and possibly 2%. So I think we're going to end the year at about 2.06%. The market's going to have to factor that in, and so the way that I look at that is to say that that's just a base case scenario. I think there's a worst case scenario, and my worst case scenario would be we see growth in the first quarter of 2019 at 0.5%. We see growth in 2019 in the second quarter at 2%, and we see growth in the third quarter at 1.5% in 2019, and then we also see growth at 1.35% in the fourth quarter, which would lead us to that gradual slowdown and that possibility of a 2020 first quarter negative, two negative quarters of growth coming into play in maybe the first quarter of 2019, and then the second quarter of 2019. Or if we have a very, very weak fourth quarter in 2019, that could be the first part of it, and then the second part would obviously be the first quarter of 2020. So in that scenario, we actually see growth significantly below trend, which would be the worst case scenario for the market. A lot of that has to do probably with the first quarter. There's likely going to be a negative shock to the U.S. dollar because of growth rates in our major trading partners. For instance, Europe, which initially you would hope would have taken the baton and would have actually been growing at a substantially faster rate than the U.S. Because they run a considerably large surplus. It's going to actually put additional pressure on the U.S. economy as Europe grows at a much slower rate during the first 3 months of the new year. PMIs in Germany aren't looking very good, and PMIs in general in Europe aren't looking very good, and that's going to have a negative effect on growth worldwide. Then you look at the Japanese economy, which is going to be in a recession and going to be growing in a negative. Negative way to start the first quarter as well. possibility of a consumption tax coming into play. That always has a negative effect on the Japanese economy. So you look at those two large economies that are major trading partners with the U.S. that are growing at a substantially slow rate, and they're also very. And then you throw in the Chinese economy as well, which due to not only the tariffs and the trade war with the U.S., but also because the fact is that in their 13th 5-year plan, China's a communist country, so they structure everything with 5-year plans. China was looking to decelerate their economy so that they weren't as attached to fixed investment-led in investments in terms of the housing sector, building cities, some of those things, and that they were going to be less dependent on export growth going forward. So as they do that, part of what they have to do domestically is that they have to rebalance their economy to shift it over to a more consumer-oriented economy, and that was part of the goal with the 13th 5-year plan from 2016 to which is going to end in 2020. And then as they look toward the 14th 5-year plan, which is going to start in 2021 and go to 2025, that shift from a export-oriented, fixed investment-led economy should transition to a much more domestic consumption-driven economy. What that means ultimately is that we should see the Chinese economy start to import more and export less, and so their balance of payment is going to greatly shift with most of their major trading partners, especially the U.S., as they become more dependent on U.S. exports of energy U.S. exports of energy and financial services and other service-oriented things where the U.S. actually has a substantial surplus with most of its trading partners. So we'll probably see that take effect. Part of the reason that I'm looking at a very negative start to the first quarter has to do with the fact that Europe is growing at a very, very slow rate. Japan is growing at a very slow rate. China is growing at a very slow rate to start the new year, and that's going to additional pressure on the U.S. dollar, and we'll probably see the dollar appreciate for the first part of at least for the first maybe 2 to 3 months. After that, we should start to see a gradual depreciation of the dollar going out for the remainder of the full year. The initial increase in the dollar is going to put considerable pressure on the U.S. trade deficit, and part of that has to do with the U.S. runs a twin deficit, which is indicative of having a $1 trillion budget deficit as well as a very, very large current account deficit. And those two factors are going to weigh substantially on the U.S. And the appreciation in the dollar is going to make that a little bit more harder to manage going into the second, third, and fourth quarter. But I think ultimately that is going to slow down the U.S. domestically, because that has like a feedback loop that feeds back from the rest of the world. And obviously, if the dollar appreciates in value, we all know that acts as a tightening. It's similar to the Fed tightening policy as well. So dollar strength is a global tightener, and it can actually slow growth globally. So I don't think the strength in the dollar isn't going to fall off until probably the start of the second quarter, even though the data in the second quarter is going to be significantly better than the data in the first quarter for 2019 for the U.S. But because the U.S. Trading partners are experiencing significantly less growth, that feedback loop has to go back to the U.S. dollar, because it makes the euro, the yen, and also should make the Chinese yuan less competitive to start the year. But I think that those those currency depreciations to start the year by those countries' currencies is going to be very short-lived. So going back into this, the second quarter is going to be obviously the strongest quarter in the U.S., and this is probably the first quarter. This will probably be the start of any rally that we're going to have in the equity market. And part of the reason has to do with the fact that things that stabilize the market, like corporate buybacks, are back in vogue during the start of the second quarter and toward the end of the first quarter. And also in general, the economic data tends to be better in the second quarter than it is in the first quarter. So some of those seasonality effects are going to be back into play. Some of the other issues are if you expect the U.S. to grow at a very slow rate for the remainder of the year, we should probably see that reflected in inflation as well. So inflation's probably going to come down from where it currently is. So the Fed targets about 2% inflation. Inflation's been running, if you look at CPI, it's been running a little bit above that. We'll probably see, even though we have tariffs, we're probably going to see inflation start to slow down in the first quarter, and part of that's going to be driven by the strength in the U.S. dollar, because that has a negative effect on inflation. It typically moves inflation lower, and in whatever domestic country it's in, if your currency appreciates, typically has a negative effect on inflation. So we probably will see inflation come down in the first quarter as well. But given the dynamics and the fact that I think the U.S. dollar is going to ultimately weaken throughout the year, and that we're going to see growth decelerate to about 2%, it should also have the effect of weakening the U.S. dollar, which means that commodity prices and different commodities that trade in the dollar are going to be appreciating in value. So how does this affect the stock market? So if you assume the base case scenario of about 2% growth for the full year, the stock market's going to be in two different positions. I mean, let's assume that the market isn't ready and that they haven't really fully adjusted to the new reality of what's taking place in the domestic economy and what's taking place globally. Let's hypothetically say that forecasts have to come down to 5%. So currently, we're assuming that the earnings per share on the S&P for the end of 2018, which we'll know by the end of January of 2019, is going to be $162. And then we're going to assume that there's a 5% decrease, which would take it all the way down to $153 and 90 cents for the full year in 2019. If you assume that the ending value of the S&P is going to be 2,900, the forward PE at that point would be 18 times where we currently are right now. Would be about 18 times the ending value. I'm sorry. So where we currently are right now, the ending value of today's ending value of 2,596 would lead to a forward PE of about 16 times, given that scenario, versus where we are today, and we make the assumption that we're going to see growth come at least 5%, which would be 170 at the end of the year, and you assume closing today's price, the forward PE is about 15 times. So the market looks relatively cheap, assuming that the information and the current forecast for earnings per share growth is at 5%. 5%, we're looking at basically a forward PE today based on today's closing price of about 15 times. That's earning per share yield of about 6.55%. I make the assumption too that if you're able to meet those targets, volatility comes down during the year, and you probably see the market just move 1% on a daily basis. So volatility will be closer to 15 to 16%. In a worst case scenario where the market is in a situation where the earnings per share are going to be negative, and let's say they're going to be negative by 2%, and so the closing value would be $158.76. So today's price, we'd probably likely see volatility remain about 25%, and that's about a 1.57 move in the market.